Another way of looking at evaluating or the valuation of stock prices and picking stocks is a price to sales ratio. Not as used as much as a PE ratio and not used as much as like a PEG ratio for value investors, but it's still very, very important. And you get that off the income statement. You're looking at your sales and the recent stock price. And the formula is the price per share divided by the annual sales per share. So you're looking at it on a per share basis, the formula. But you can find these, they'll say P/S, a P price to sales. And it's like price to earnings or price to book or some of these other pricing comparison to something ratios. And price to sales, you're looking at, what kind of price did you get or what kind of price are you willing to pay for $1 of sales is one way to look at it. And you're really kind of comparing firms based on their sales relative to their pricing in the market. So if you've got a company, let's say that has a price to sales of 2 or 2 times and another one of 4 times, well, that means you're paying a high price for that 4 times company. And you want to ask yourself, is it worth it to pay for that sales? Is it worth to pay that much? Or is it a better value maybe to go with the 2 times one? So it could be good or bad either way, but the lower the price of sales, you might be a better value when you're looking at stocks. A price of sales that's high might be a higher price relative to its sales. And a lot of people like price to sales. I like price to sales too. Amongst all these ones that we're learning about, all these different ratios taken together, all within the industry, so we keep saying that over and over again. But it's good because when you look at like earnings and things, frankly, there can be a lot of different manipulation around earnings. Some are criminal, and you might hear stories where there's criminal manipulation and hiding things off the books and all that, and that's terrible and illegal. But there's also some manipulation as far as when you receive money and when it's going out and what you're expensing and not. There can be a little bit more. You can play a little bit more with like earnings, and many companies do to hit a certain earnings number. They've projected earnings, and if they don't hit their number, their stock's going to down. So you might see a little bit around them. But sales is a harder number to manipulate because, you either made a sale or you didn't make a sale. It's either showing up on the revenue line of your income statement as revenue or sales, or it's not. So it's a little bit harder to hide that or shift it. But it can be done. Anything of these things can be done with magical accounting, I guess. But it's something that's a little bit harder. So a lot of people like price to sales because it's a little bit more consistent of a number and a little bit more reflective of an organization as far as the numbers. So it's just another evaluation and a good valuation to say, hey, in order to grow, in order to do well as a company, we need sales. We can always cut and reduce our expenses, and we can do that. But the bottom line, we need to grow sales and grow sales relative to our price to be a good value company to maybe buy. And if we're not growing sales and our stock price is maybe real high, that might be something to look at and maybe avoid. You're looking for companies with good sales, growing sales, and if their price is undervalued, hey, that's great. Have that lower price to sales ratio. So another thing to look at, something a little more consistent, is price to sales. But I would consider it with price to earnings and some of these other ratios as well.